There's a detail buried in SSA's own rulebook that most financial advisors never think to mention. If you claimed Social Security at 62 and you did it within the last 12 months, you still have a legal option to undo it completely, like it never happened. It's called a Withdrawal of Application. You file Form SSA-521, pay back what you received, and SSA wipes the record clean. Your benefit resets to what it would have been if you had never filed. I wish I could tell you this system is straightforward. Honestly, I had to read through SSA's own rules 3 times before I fully believed this provision existed. But it does. Now here's why I'm telling you this up front. A lot of people who claimed at 62 feel like the door closed behind them the moment that first check cleared. And that feeling is understandable, but it's not entirely accurate. The door is not always closed. In some cases, it's just on a timer. If you're still inside that 12-month window, you have a full reset available. If you've passed it, there are 2 other legal tools from SSA that still let you recover meaningful ground. And if you have a spouse, there's a survival math problem we need to walk through together, because your claiming decision didn't just affect you. This video is not about what you should have done differently. It's a damage control playbook built around 3 actual SSA mechanisms and a tax strategy built for the bracket reality of 2026. Get a pen. Some of this gets specific. Let me tell you about Tom. Tom spent 28 years as a structural engineer. Good career, solid income. Then at 61, his company went through a round of layoffs, and his position was eliminated. He spent 7 months job hunting, burning through savings slower than he expected, but faster than he was comfortable with. By the time he turned 62, he filed for Social Security. Not because he had run the numbers carefully, because he was exhausted, and the check felt like solid ground. His neighbor had done the same thing 2 years earlier. Nobody told Tom there was another option. I've seen this walk through the door more times than I can count. And the version I hear most often isn't recklessness. It's a very rational response to feeling financially exposed. There's a name for what Tom experienced: loss aversion. The fear of losing what you already have tends to hit harder than the appeal of gaining something better later. SSA going broke was a real worry circulating in his world. So was the idea that waiting meant gambling on your own health. When the check became available, taking it felt like the responsible move. That instinct isn't a character flaw. It's behavioral economics doing exactly what it was designed to do. The shame piece is what I want to address directly. A lot of people come to this topic carrying real embarrassment about having claimed early, like they missed an obvious warning sign that everyone else caught. But here's what I actually see when I look at the data. Roughly 1 in 3 Americans still files at 62. That's not a fringe group making an unusual mistake. That's a very large number of people responding to real pressure with the tools they had at the time. Shame doesn't adjust your benefit, and it doesn't help you figure out what to do next. What does help is separating the decision from your identity. You made a financially significant move under conditions that were genuinely stressful. That's the whole story. It doesn't mean you're bad at money. It means you're human. So here's where we go from here. We stop relitigating the past and we open the toolbox. SSA gives people in your exact situation 3 legal mechanisms to recover ground. The first one is the most powerful. It's also the one with an expiration date. Start with the most powerful option first. If you claimed Social Security at 62 and you are still inside the first 12 months of receiving benefits, you have access to something SSA calls a Withdrawal of Application. The form is SSA-521. 1 page. You fill it out, you pay back every dollar you received, and SSA treats the whole thing as if it never happened. Your earnings record resets. Your future benefit recalculates from scratch, as if you never filed. That's not a loophole. That's an official SSA provision that most people never hear about. Tom, the engineer we talked about earlier, found himself at month 8. He had received about $14,400 in benefits by that point. Not a small number to hand back. But when he ran the comparison, the math was clear. Claiming at 62 had permanently reduced his monthly benefit by roughly 30% compared to what he would have received at his full retirement age of 67. Using SSA-521 to withdraw and reset meant recovering that full 30% reduction every month for the rest of his life. He pulled from a brokerage account to cover the repayment. It was uncomfortable. But he did it, and the record was wiped clean. Now, what if Tom had waited 18 months instead of 8? The window closes at 12 months. Once you pass it, SSA 521 is no longer available. The reset is gone. But that does not mean the story ends there. This is where Tool 3 comes in, and it operates completely differently. If you claimed early and you are still working, or if you return to work part-time, SSA runs a quiet recalculation every year. They compare your current year's earnings against your existing 35-year record. If 2026's income is higher than one of the lower years already in your file, they replace that year and recalculate your benefit upward. Automatically. You don't have to request it. It just happens. This matters more than people realize. A lot of people assume that claiming at 62 locks their earnings record permanently. It does not. The record stays open as long as you have earned income. So if Tom is now past that 12-month window but picks up part-time consulting work, each year of meaningful income gives SSA another opportunity to push his monthly benefit slightly higher. It won't fully close the 30% gap that early claiming created, but it chips away at it legally year by year. Two different tools, two very different situations. SSA 521 is surgery. The recalculation mechanism is physical therapy. If you're not sure which window you're in, the date on your first benefit payment is your reference point. Count forward 12 months from that date. That's your deadline for SSA 521. But what if you've already passed that deadline, you're not interested in going back to work, and you still want to recover some of what early claiming cost you? SSA built a third option for exactly that situation. It doesn't kick in until age 67, and it requires patience. But for the right person, it changes the math significantly. Here's the situation this tool was built for. You claimed at 62. The 12-month window has passed. You're not planning to go back to work. And you're sitting with a monthly benefit that's permanently reduced compared to what you would have received at 67. You still have one move left. SSA calls it voluntary suspension. Here's how it works. Once you reach your full retirement age, which for Gen X is 67, you can contact SSA and ask them to stop sending your checks. You're not canceling your benefit. You're pausing it. And every month that benefit sits suspended, it earns what SSA calls delayed retirement credits at a rate of 8% per year. If you suspend from 67 all the way to 70, that's 3 years. 3 times 8% equals 24% added on top of whatever benefit you were already receiving. Now, that 24% is being applied to a base that was already reduced by early claiming. So it doesn't fully erase the penalty from filing at 62. But it closes a meaningful part of the gap, and it does so without requiring you to repay anything or return to work. I remember a client, I'll call her Sarah, who came in holding a printed copy of her SSA statement. She pointed to age 67 on the page and asked me a very direct question. She said, "Can I skip restaurants for 3 years so I don't have to worry about prescription costs at 85?" The answer was yes. For her situation, it was yes. That's the core trade rate-off of voluntary suspension. For 3 years, from 67 to 70, you have no Social Security income coming in. That gap has to be covered by something, savings, part-time income, a spouse's benefit, a Roth account. If you don't have a bridge for those 3 years, suspension doesn't work in practice, no matter how good it looks on paper. But if you can fund that gap, the payoff starts at 70 and runs for the rest of your life. And because Social Security includes annual cost of living adjustments, that higher base compounds over time. The longer you live past 70, the more the math favors having suspended. This is not a tool for everyone. If your health situation suggests a shorter horizon, or if you genuinely cannot cover 3 years without that check, suspension may not be the right move. The mechanism is real. The benefit is real. But it has to fit your actual cash flow, not just a spreadsheet scenario. What voluntary suspension does not fix, and this is important, is the impact your early claiming decision has on the person who might outlive you. That's a separate problem, and it may be the most expensive one in this entire playbook. If you're finding these strategies useful, hit subscribe. We work through this kind of detail regularly, one piece at a time. There's a number most couples never look up. According to SSA's own actuarial tables, a woman who reaches 65 today has a meaningful probability of living past 85. For men at the same age, that number is noticeably lower. That gap, roughly a decade of potential difference in lifespan, is what makes survivor benefit the most financially consequential piece of this entire conversation. Here's how the math works in practice. Say a husband is the higher earner in the household. He claims at 62, takes the reduced benefit, and the household runs on that income, plus whatever his wife receives from her own record. That setup can work fine for years. But the moment he passes away, SSA doesn't send 2 checks anymore. The surviving spouse receives 1 benefit, and it's capped at the higher of the 2 amounts the couple was receiving. If the higher earner claimed early, that cap is already reduced permanently. So the wife, who statistically has a good chance of living another decade or more on her own, is now drawing from a benefit that was discounted at 62 and never recovered. She didn't make that filing decision. She didn't sign the form. But she lives with the financial outcome of it for the rest of her life. That's the part that doesn't show up in the initial claiming conversation. Nobody sits across from a 62-year-old and says, "Let's talk about what your spouse receives if you die at 74. The trade-off here is stark. 5 or 6 years of a slightly higher household income in the early retirement years can translate into 10 years of financial pressure for a surviving spouse in her 80s. Reduced monthly income at exactly the point when healthcare costs tend to climb. I've seen this play out. It's quiet damage, the kind that doesn't surface until it's already locked in. Now, if you're already past the 12-month window and voluntary suspension isn't feasible for your cash flow, the survivor benefit problem doesn't have a direct SSA fix. What it has is a workaround strategy, and that strategy lives outside of Social Security entirely. It means protecting the other assets more deliberately. It means looking hard at what the surviving spouse would actually need per month and building a floor under that number using accounts and tax strategies that you still control right now. Which brings us directly to the tax environment of 2026. Because the rules changed at the start of this year, and if you're pulling from a traditional IRA to supplement a reduced Social Security benefit, the cost of doing that carelessly just went up. The Tax Cuts and Jobs Act expired on December 31st, 2025. That's not a projection. That's done. Starting January 1st, 2026, the individual tax brackets shifted. What was 12% is now 15%. What was 22% is now 25%. If you've been mentally budgeting your retirement withdrawals based on the old brackets, those numbers are no longer accurate. For someone drawing a reduced Social Security benefit from an early claim and filling the gap with traditional IRA withdrawals, this change has a direct cost, and most people haven't recalculated. Here's the mechanism that makes this more complicated than just a bracket shift. IRS has a concept called provisional income. It's a formula that determines how much of your Social Security benefit gets taxed. The threshold for married couples filing jointly is $44,000. If your combined income, which includes half of your Social Security plus all other income sources, crosses that line, up to 85% of your Social Security benefit becomes taxable. That threshold has not been adjusted for inflation since it was written, which means more retirees cross it every year without doing anything differently. Here's what that looks like in practice. A couple drawing a reduced Social Security benefit of $28,000 per year. They pull $40,000 from a traditional IRA to cover the rest of their expenses. Their provisional income calculation pushes them past $44,000. Suddenly, 85% of that $28,000 Social Security benefit, that's $23,800, is sitting in taxable income. At 2026 rates, that's being taxed at 25%. Not just the IRA withdrawal, the Social Security income too. That's the tax torpedo. One withdrawal decision activates a second tax hit that most people don't see coming. Now compare that to a household running the same total spending but pulling differently. Instead of $40,000 from a traditional IRA, they take $15,000 from a taxable brokerage account, $15,000 from a Roth IRA, and $10,000 from traditional IRA. Their provisional income stays under $44,000. Their Social Security benefit remains largely untaxed. Their effective tax rate drops significantly. Same spending, different accounts, completely different tax outcome. This is what I mean when I say how you pull money matters as much as how much you pull. The window to restructure this is not unlimited. Required minimum distributions kick in at 73 under Secure Act 2.0. Once RMDs start forcing money out of your traditional IRA every year, your ability to manage provisional income gets much harder. The years between now and 73 are the years where intentional Roth conversions and strategic sequencing of withdrawals can move the needle most. If you're 62 or 63 right now, you potentially have a decade to work with. That's not a small window, but it closes faster than it looks from the inside. The mistake I see most often in this phase isn't recklessness. It's just defaulting to the familiar account. People pull from traditional IRA because that's what they've always contributed to, and the money feels most accessible. But in 2026, that default is more expensive than it used to be. The next question is what specific moves cross the line from damage control into making things worse. Because there are a few, and they're easy to stumble into without realizing it. There are a few moves that feel like damage control, but actually make the situation worse. These aren't exotic mistakes. They're the ones that show up most often precisely because they look logical on the surface. The first one is pulling large amounts from a traditional IRA in a single year to get ahead of future taxes. The instinct makes sense. Taxes might go up later, so take the money now. But in 2026, a large single-year withdrawal can push your modified adjusted gross income high enough to trigger Medicare IRMAA surcharges. IRMAA works on a 2-year look-back. What you report on your 2026 tax return determines your Medicare Part B premium in 2028. If that income crosses certain thresholds, your monthly premium can jump by hundreds of dollars above the base rate. Not once, every month for that entire year. So the move that felt like tax planning ends up quietly eroding your healthcare budget 2 years later. The second mistake is ignoring the Roth conversion window entirely. I'll be honest about something. For a long time, my default advice leaned heavily toward deferring taxes as long as possible. Keep the money in the traditional IRA, let it grow, pay taxes later. That framework made sense under the old bracket structure. With the 2026 brackets now in effect, I've had to revise that position. Paying taxes today, strategically, at a rate you control, is often less expensive than letting RMDs force distributions at rates you don't. The years between 62 and 73 are the lowest control pressure window most retirees will ever have over their taxable income. Using some of that window for measured Roth conversions, staying within a bracket you can manage, is not aggressive tax planning. It's basic math. The third mistake is treating all accounts as interchangeable. $1 in a Roth IRA, $1 in a traditional IRA, and $1 in a taxable brokerage account are not the same dollar. They carry different tax costs at withdrawal, different implications for provisional income, and different treatment under Medicare's income calculations. Pulling from them in the wrong sequence doesn't just cost you on this year's return. It compounds across every year that follows. The through line across all three of these mistakes is the same. Each one feels like a reasonable reaction to a stressful situation. Each one trades a short-term sense of control for a long-term cost that doesn't show up on the same page. Damage control, done right, is slower than it feels like it should be. It's less about making a big corrective move and more about avoiding the moves that create new problems while you're trying to fix old ones. So where does that leave you? Let's put the full picture on the table. 3 legal tools from SSA-521 if you're inside the 12-month window and can cover the repayment. Voluntary suspension if you can fund a 3-year gap between 67 and 70. And the earnings record recalculation, which works quietly in the background as long as you have earned income. On top of that, one tax framework to protect what's left. Manage your provisional income below $44,000. Sequence withdrawals across account types deliberately. Use the years before 73 to do Roth conversions at rates you choose, before RMDs start choosing for you. None of this requires a perfect starting point. It requires knowing which tools exist and applying them in the right order for your actual situation. Claiming at 62 was not the end of the plan. It was one decision inside a much longer timeline. The question now is not what you should have done differently. The question is what you do with the position you're actually in. That shift in framing matters more than people give it credit for. Moving from "I made a mistake" to "here's how I optimize from here" is not just a mindset adjustment. It changes which actions you take and when. Retirement finances are not a test with one correct answer. They're a sequence of decisions, each one made with the information available at the time. The goal from here is to make the next decisions more deliberately than the last ones. I'm Wes. If this kind of specific, practical breakdown is useful to you, hit subscribe. We'll keep working through the details together, one video at a time.